Hi. So I deliberately gave a rather vague title because I didn't know what the latest trends were going to be. So I peppered a few bullet points a few days ago and wrote this talk based on actually the first time I've spoken about my own research in crypto. I've done quite a few talks on general education, you know, crypto and blockchain, but never on my own research. So before we get onto the topics that I'm going to cover, here's the papers. I put them up last weekend on the SSRN website. And they're all with students. I always like to work with students. It's a lot more fun than working with grown-ups. So the first one is looking at the data. There's so much data everywhere. We're spoiled for choice. We can get data at the minute frequency and data on all sorts of things like hash rates and volumes and so forth, but people don't really know what data is correct and where they should go for the best data. So there's a sort of Sherlock Holmes investigation into that in the first paper. The second one is looking at the role of futures in leading prices, homing in on the two large ones that Elliot mentioned this morning, the CBOE and the CME. I mean, by far the largest share of Bitcoin futures in BITMEX, which they have $1 futures, they have perpetual futures, and most of the retail investors that deal in Bitcoin are actually using BITMEX for hedging. These large contracts, particularly the CME contract, which is 5 Bitcoin, well, could be up to 100,000 per contract when Bitcoin, if it ever does get back to $20,000, are only really for institutional. And then, of course, the position risk, if you want to hedge with those, is going to be massive. So you'd have to have massive positions on Bitcoin, which don't exist. We saw hedge funds don't have much more than 10 million. So they're not used for hedging, those futures. They're used for speculation. So we zoned in on one or two of those futures contracts to see whether we could uncover any evidence of futures deliberately leading spot price in one direction or another. And incidentally, today, midnight UTC, is when one of the penultimate CBOE contracts actually matures. And there'll be a lot of activity today, which is it's very interesting that Anton took that picture of the flows in the network at the moment with the behavior of not only Bitcoin, but Ether as well, and other, Ripple and so forth. And then the last one, I just played around with the Deribit data. Arben and Daniel are master's students at Technical University Munich. And so they're in the maths department, very good at scraping and so forth. And so, in fact, all of them log into the API and get data. What Arben's been doing is taking 15-minute snapshots of the Deribit options. And so we've derived our own volatility index. We have to call it the BITIX, not the BIX, because the BIX is a bunker index. Everything's much faster time. You'll see that the way we suggest variance swaps might be traded, and if you speed up time and you look at 7, 14, 21, 28-day maturity with 15-minute log returns rather than daily, you get features that are very similar to equity. So I should imagine that very soon we're going to be getting some exchange-traded products based on BITIX. Okay, so 4 different subjects. First of all, data are free, but some are wrong. Secondly, looking at the arbitrage between centralized exchanges. What I was talking about with Anton are the DEXs, the decentralized exchanges. But on centralized exchanges, Binance, Bitfinex, all the large, massive exchanges that make up this huge ecosystem. Arbitrage is more or less dead now. So just looking at why that is and the causes for it. And then, as I mentioned before, the last 2 topics. All right, so here's a little picture to motivate. In fact, most of the talk's just going to be pictures or tables. If you can read from the back, I don't know whether you can. Market betas, okay, simple single index model. Betas, T-stats in parenthesis. So, for example, this number here, the data is CoinGecko, Bitcoin data. The market index is the CCI 30. This is the beta, and that's the T-stat. And so I've looked at exchange prices, these are traded prices, on the 5 sort of major exchanges. If you cut out the ones that are wash trading, because they're what they call zero fee exchanges. So in that ecosystem that Anton just showed, new exchanges can apparently seem very, very successful because volumes are created by the market makers who set up wash trading on both sides because there's zero fees. In fact, they're rewarded with the exchange's own tokens for doing the trades. So you have to discount those, and in that case you get other exchanges here. But nevertheless, Kraken and Bitfinex are both Tether exchanges, and that's another issue. Anyway, so those are the major exchange prices, and they are traded prices. And these are the coin ranking sites. So this ecosystem where you've got the exchanges, you've got the coin ranking sites, and you've got the issuers of the ICOs, you know, these thousands of crypto assets, they live in a sort of synergy where the coin ranking sites will refer people that go to them to various exchanges. So another topic I don't have time to talk about, but these coin ranking sites have a vested interest in providing good data. And their VWAP prices, based on the volumes that they get on Bitcoin, the crypto compare ones are only based on 40 USD traded prices, and they're real USD prices. They don't look at cross prices like Bitcoin, Ether, Ether USD, because it's very difficult to infer a volume for VWAP from that. The CoinGecko prices take about 400 possible price pairs with lots and lots of crosses, as does CoinMarketCap. So these are questionable just on that score. But then when we look at these betas, just have a look at the CoinGecko betas relative to three market indices. So there's the CRIX, CCI 30, MVDA 25. They're all cap weighted, although CCI 30 is square root of cap because of Bitcoin being too big. But they've got 80% overlap in the number of assets that they use. So they shouldn't be too different, but look at the betas. And then if we just look across there, there's something really weird with the CoinGecko ones. And then one would expect, Bitcoin is the least volatile, so it wouldn't have a beta over 1. Something like 0.7 is probably pretty good. I mean, these numbers I trust. These seem a bit low. And then let's have a look at Ether. Ether is more volatile, not as volatile as Ripple or any of the others, but okay, a beta of 1 seems all right, 0.5, and so forth. So there's something really weird going on with these data. So we had a look at the CoinGecko data. We like cryptocompare because it's only using 40 in the VWAP. But with CoinGecko, this is a percentage spread. So it's CoinGecko minus cryptocompare divided by cryptocompare for Bitcoin and for Ether. And something really weird happened on the 30th of January last year. It suddenly went off. So I said to Michael, well, lag it. And we found this. And then, of course, we found that they're still producing this type of data. They haven't changed, although we did write to them. And so what you have to do, if you want to use CoinGecko data, which I wouldn't recommend because of the VWAP, is to just take out one of the observations on the 30th of January on 2018. Then it's all right. Now, the CRIX is an index that uses CoinGecko data. So, of course, any problems with CoinGecko will feed automatically into the CRIX. Of course, the difference between CRIX and CCI 30 won't be the same because they're different indices. For example, CCI 30 has a different square root rating, for example. So, we don't expect a straight line here. But again, obviously, the problems in CoinGecko have carried over to CRIX, and that explains why we get some really strange betas. But then later on, when I look at the really, really complex Garch modeling, and we've tried 20 different Garch models. We've tried MLE, we've tried MCMC. It's really, really sensitive to the data that you use. This is what we've decided is probably the best one, which is the student T GJR switching Garch with 2 states. And it's very nice work by David Ardier at St. Gallen, who wrote a very good program. We had to modify the leverage coefficients to be the opposite sign. So we worked with him to get these results. It's not too bad. By the way, I've only used Bitstamp and Kraken because we want to go back to 2013 and we can't get data on the other ones. We need a lot of data for a Markov switching Garch. It's not too bad. I mean, unconditional volatility in the low volatility states do differ quite a bit depending on your data source. Obviously, we don't expect these to be the same as the traded prices, but the traded prices between Bitstamp and Kraken are reasonably different. And then when we go to the high volatility state, again, you know, it's really, it'll be highly sensitive to the exchange that you use. So what can we take away from this, you know? It does matter whether you use an exponentially weighted moving average or a Garch or so. You know, this is just a UMA equally weighted moving average with 30 and a standard student TE Garch. And you can get differences of 100 or 200% very easily, particularly on Ether or Ripple, depending on the model you use. So you do need to use a good model. You need to, if you're using MCMC, you need a DIC selection criterion. But it will depend on which exchange data you're using. The whole, and this is only daily. As soon as you start going intraday, it's a real monster to try to deal with this type of data. Okay, so I could take questions on that, or I could go on. I'll go on. Arbitraging CEX prices. Okay, so we have to adjust prices from Bitfinex and Poloniex are Tether prices. So we multiply those by the, we can get this cross rate going back all the way from Kraken. Okay, it's a different exchange, but I'm not showing you the graph of the Bitfinex and Poloniex prices before we adjusted for Tether, which were way off. Once we've adjusted for Tether, the Bitcoin, I mean, there still obviously was some possibility for exchange arbitrage, which we'll look into later, until earlier this year. But then something really weird happened on Bitfinex. And that coincided with the announcement of USD, US Tether trades on margin. So you can actually print a Tether, use it to buy 10 USD, and then take those USD wherever you want to buy Bitcoin. And one wonders whether that has a lot to do with the current boom in Bitcoin that we're witnessing right now. There's all sorts of reasons. There's the futures that are going to mature, so that the futures could be pushing the price up. Somebody may have a long position that they have to close out, you know, because the CBOE can't roll over anymore. Could be all sorts of reasons. Could be because of, Fidelity and so forth are getting into the market. But, I think that the Tether is the most likely reason for the recent boom.
Sorry, Carol.
Yeah.
When you talk about arbitrage, are you talking about arbitrage between cryptocurrencies which remain on the same exchange? Or,
So what you need... so you have an account, if you want to do an arbitrage between Bitfinex and Poloniex, then you have accounts on both exchanges and buy, sell on those exchanges. Same coin.
Okay, and the time spent between these two trades?
Simultaneously, you can have bots to do it. If you look at the exchanges, it's amazing how you can see spoofing in particular. The bots are running those exchanges, so you just do it on the bots. If you log into Coinbase and just have a look at it, at the moment there'll be a lot, particularly on Bitcoin USD. So I looked at 10-minute data over these exchanges. Well, not all of them. I mean, I'm showing some. Coinbase, Bitstamp, Kraken, Itbit, Gemini, Coinbase, for example. Looked at the 10-minute, every 10 minutes I looked at the percentage spread between them. And I did that 10 minutes throughout the day and then averaged over the day to find the percentage spread every 10 minutes averaged. So every day you could see, you know, unless you got, well, later on now, we're hardly getting 10 basis points difference in the spreads. So it's going to be really hard. I mean, these are average, so if we traded high frequency, we might find that we could get some exchange arbitrage. So we tried various Bollinger Band type strategies, just on 10-minute data illustrated here. So, you buy when it hits the lower bound, sell when it hits the upper band. Actually, we should really make that green and that one red, shouldn't we? Green for a buy, red for a sell. Yeah, I'll have to change that. Anyway, so arbitrage profits did exist. This is assuming 10 basis point transaction costs, which is about right. This is in dollars per trade or something. I can't remember. I have to remind myself about the unit of measurement. But the point is that CEX arbitrage has disappeared, although DEX arbitrage is live and kicking. I mentioned, if you weren't here at the previous talk, there's a paper just come out on the archive by some guys in Cornell. 8 people got together on analyzed the blockchain and front running of Ethereum smart contracts executions, and they uncovered quite a lot of arbitrage that's going on there. Doing quite well. That's what comes when you don't have any equations or words. Okay, so now let's have a look at the CME and Cboe futures. Here's the trading volume in Bitcoin, because the Cboe contract is only 1 Bitcoin on the underlying. It settles at the Gemini auction price, and the CME settles at the Bitcoin reference rate, which is a basket rate, a little bit like an index price for Bitcoin. So CME have clearly grabbed the market share. They started very end of 2017, and around then, Cboe decided to delist. And they settle at different times. The CME settles at this Bitcoin reference rate at 4 p.m. UTC. 4 p.m. UTC on the last Friday of the month. The Cboe settle at the Gemini auction price at 1500 Chicago time on second Wednesday of the month. So that's today. And what's 3 p.m. Chicago time? It'd be very interesting to see what's happening leading up to that settlement. I'll tell you why in a minute. So this is what they look like over the period that we have the initial data. The first study uses just 30-minute data because it wasn't possible to download very much of a history using 1-minute data. We now started downloading a month at a time from Thomson Reuters, the 1-minute data, so we can do a little bit more of an analysis on what's happening today. We looked at 30-minute frequency for price discovery, which is about the lowest frequency you can go to. I'd much rather look at price discovery on 10-minute or 1-minute. But as I said, we didn't have enough data. We only had 30 minutes going this far back. So we had to replicate the BRR, but we just got the same exchanges, and just it was very easy to replicate it. There is a slight difference between the BRR. This is just comparing our high-frequency BRR with the actual BRR quoted daily at exactly the same time. So, there is a bit of difference, up to 1%, but it's more or less okay. And then we use the Gemini exchange high-frequency price, and then compared it with the Gemini auction price. Gemini auction is a very strange auction that's used for the settlement price. And again, we do find some anomalies up to about 1% difference, but not huge. So we're going to use this high-frequency data for the price discovery analysis. And I'll spare you the mathematics. I'm sure this audience would be fine with it, but those of you who are already fine with it will understand the words. So basically, I use a vector error correction model, because, of course, spot and futures are co-integrated. You look at the disequilibrium term, that'll give you an idea of the strength of the relationship between the two. One has to be positive, the other has to be negative, otherwise it's not an error correction. And then you can decompose that using some sort of distributed lag into a sort of moving average model, on which you can quantify a bit like analysis of variance or principal components, the proportion of variance explained. And this is what we call the Harsbrook information share. And there's a generalized information share, which is more sophisticated, which you need when you've got correlated residuals. And there's something else called the component share. And these are measures of price discovery. And in developed things like agricultural futures, you find that futures can very often lead spots, particularly like oil markets as well, with information shares of about 70% or so. So that's the ballpark figure for something really leading the price discovery. So first of all, we looked at rolled over futures because almost all the trading's on the prompt. We didn't worry too much about not having constant maturity. We just went to one day and rolled to the next. So we had a long series on which we could estimate the error correction model, look at the error correction coefficients, and then analyze the component shares. And the one thing that stuck out to us was this very large component share on the CBOE futures, 77%. For the futures, showing a lot of price discovery coming from the CBOE. So then we drilled it down first of all, we looked at the basis derived from these rolled over contracts, realized that this contract here, something very fishy going on, this one here, these are on the settlement days, that something strange is happening, the futures and the spot may be decoupling in some way. So looking at the individual contracts, let's just zone in on, say, this one. I don't know whether you can see it anyway. It's a bit small at that side of the room. But here you can see on November the 18th, CME, it seems to be the spot that has the component share. These blue figures here are caused by very, very low trading volumes. But then when we move to the December and January CBOE, we see some extra coming from the future. It's still not that much because we've only got a short bit of data. But anyway, I won't go into too many details about those figures. Just have a look at the CBOE December contract on the 14th of November. This was the settlement day for the November contract, and most of the trading was actually on the December contract by then. And so the basis on the December contract, well, there was no trading, so I couldn't fill all those in. The trading started about the 13th of November, the last few days, and then the futures price went down way before the basis. So obviously futures seems to be leading the spot there. And so the similar pattern to this we found on the CME November contract, because the CME November contract was still running at that time. It didn't expire until the end of the month. So then we looked at 30-minute trades on that day, just on the 14th, and found that this number here is the proportion of trading on the futures as a proportion of the normal volume at that time. So you can see that 5 times the normal volume and then 25 times the normal volume. We need higher frequency data to know whether this was actually precipitating this decline here because of the price discovery. We shall see. Similar pictures from the CME as well. Anyway, this is sort of work in progress. I haven't quite got this paper ready for submission, and I'll take questions on that later. Let me just move to this paper, which is a little bit more, it's a small study and a little bit more advanced, easy to do. So looking at deribit options, Deribit's the only exchange that offers Bitcoin options and Ethereum, Ether options. Actually, Ethereum's the blockchain, Ether's the coin. This is just a snapshot of the prices. We started taking snapshots at the beginning of March, every 15 minutes using the API. And the Bitcoin spot price was around 5,000 at that time. So, of course, most of the trading, particularly on the very short term. So this is 1 day options. This is 8 days, because they mature every week. So you've got the 12th of April, the 19th of April, 26th, 31st. And then there's a month, and then they do quarterly. So it's 2709 and 2712. So the trading on the quarterly actually was much broader range, of course. You do actually get some deep out of the money puts and deep out of the money calls. But obviously, it's the usual trading envelope, basically. So this is to justify why we decided, because when we look at the volume figures, most of the volume is up to about a month, as it is on most options, indeed. So we decided we were going to be using high-frequency data on the shorter end, although I have got figures for BITIX indices for 30, 60, 90 days. I'm not showing them here. So just to remind you, I'm sure I don't have to remind this audience of the Vix formula. This is simple gamma replication of the log contract. And this was introduced by Goldman Sachs, Emmanuel Derman, Demer Turfy, and so forth, worked with the CME on this version of the Vix. There was an earlier version that Whaley introduced, which was revised with this. So basically, you've just got the gamma weight from the inverse of the square of the strike. Anyway, another topic. You all know about the Vix formula. And the way it's done, we interpolate to constant maturity, whereas now we're looking at seconds in a year instead of trading days. So this is the out-of-the-money option price. This is the increment in the strikes, which you saw here. So what does it look like? This is what it looked like from 13th of March until yesterday. And it's a term structure just showing 7, 14, 21, 28, which is in contango, and the 30, 60, 90, around 40% at that time. Then the whole thing moves into backwardation. Much longer than you would in the VIX. VIX hardly ever goes into backwardation, and that's because of the trading on the VIX futures and the ETPs. Everybody wants to redeem as soon as it gets high. So, there's quite a lot of potential for introducing exchange-traded products based now. There is this index. And, of course, it's gone up a lot recently on the volatility of Bitcoin. Looking at realized volatility, so we're looking at 15-minute log returns and computing realized volatility as the sum of the squared log returns over 7 days, the next 7 days, of course, or the next 14 days, and so forth. And then the variance risk premium, which as a payoff to a variance swap will be the difference between the long position on the realized variance, and then you take off the square of the BITIX. And it has features which are quite similar to the equity variance risk premium. This is what you see in S&P 500, only not on the same time scale. I mean, this would be months in the S&P 500. But the magnitude, the standard negative variance risk premium until things get volatile is quite remarkable. Because, when I talked about the volatility problems with GARCH models and strange leverage effects, I wasn't necessarily expecting a fairly standard negative variance risk premium, particularly since variance goes up. Ricardo, yeah, of course, I've more or less finished.
Just one quick, the loss at some point.
Oh, sorry.
Both the BITIX and the variance swaps are not traded at the moment.
No, the options are.
How do you define the risk premium?
As a payoff to a variance swap. So I calculate the realized variance, the standard way. So it's the realized variance, yes, over the next 7 days.
The market instrument?
The fair value. I use the BITIX as the fair value. There's no market value for any variance swaps.
So you assume that the market would be the theoretical
yes.
Derman formula?
Yeah.
Okay. Thank you.
Well, that's it, actually. So there we are. And those are the papers, hot off the press. So, any questions?